Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today is our favorite day, the Primary Vision Frac Spread Count show. So we're going to do our normal Frac Spread Count, then we're going to look at some of the recent events that have come up in terms of hurricanes, some of the other things that are starting to come and get talked about with Libya, and some of the other OPEC meeting coming up. And then we're just going to do a quick introductory in terms of some of the things we're going to talk about in the Econ show next week with some of the recent data that has come out. So without further ado, we get to talk about the frac spread count, and we had an increase of 4. So we went from 236 to an increase of 240. And a lot of that was really driven by the Permian, with the Permian starting to come back. We had a little bit in Denver. So one of the things that we've been talking about when we look at the Permian is that this is where obviously we're going to see an outsized portion of the activity going forward, but we're still going to have some more coming back when we start looking at the Haynesville, the Eagle Ford, and then when we start talking about the Marcellus, which was when we look at production and natural gas production, things have been fairly stable. And when we look at pricing currently sitting at $4.37, you always have to think about, okay, well, we've been here before. We know what it's like to be elevated, but what is the curve saying? What are things looking like in general? And when you turn to the curve and look at what the expectations are, it always gets thrown out as, well, what about the weather? Because it always comes down to, what is the winter going to do? We've been in this very bullish point, and then all of a sudden had a really warm winter and then didn't see things play out. But with that being said, we still remain fairly low on the spread count side when we look at natural gas, because a lot of the additions that we've seen have really been weighted towards the oil side. And I know when people look at the spread count and they say, oh, well, spreads are really far down versus where they have been historically, which is 100% true, but you have to look at what are the spreads oil versus gas, because a lot of that disconnect still is on the gas side, and we've actually gotten back to a normal level when you think about the Permian, especially when you start factoring in some of the innovations and the adjustments that have been made over the years. So this is going to be something to watch. We've talked about constantly. We had our AOGR article come out. It's on our website. It's on our Twitter handle. And I've tweeted it out as well, but I tweet out a lot of things, so that might get a little tough to find. But when we look at it, rigs are going to continue to come back. It's just stabilizing the DUC count, getting kind of to that next level with a steady grind higher now as we look in terms of what we see on the frac spread side, with another about 10 to 12 spreads likely to come back into the fold as we progress through the next 2 weeks and as we get into the middle of September. So now we're at that time of year where we get to talk about what is happening in the Gulf of Mexico as we start looking at a hurricane coming through. So Hurricane Ida is on its way, and right now we have about 59% of oil production that has been cut. Right now it's estimated at about 1.7, 1.8 million barrels a day, and that's likely to be the peak in terms of what we're going to see. And then we've had about 49% of gas shut in, which is about, I think it's about 800, almost 1 BCF a day. So that this could change a little bit, but right now this is pretty much what we're looking at. So when I showed the ships that are currently getting out of its path, because typically you have the boats move out of its path and then come back once it's gone through. Now, one of the things that we always like to highlight, crude, is the difference between crude and refining, oil production and refining production. Because when you look at refiners come down, they usually go to what's called a safety margin, where in case there's a power outage, in case there's some sort of disruption, there's not a huge problem, or they'll shut down completely and just make sure that there is a controlled shutdown instead of essentially an unplanned one that can cause some damage, and it takes a little bit longer to come back up. So when we look at production coming back and refiners coming back, production typically comes back quicker, within usually 24 to 72 hours, and then refiners could take longer depending on how is the power disruption, is there extensive damage within the fence line, but it usually comes down to how quickly can power be restored back to these facilities. So right now, what we've seen is Louisiana gasoline demand is up sharply versus yesterday, according to Gas Buddy, about 25%. Not surprising, as people rush to fill up, make sure that things have been, that they have enough fuel available. Gas Buddy has activated their fuel system that looks at where are stations that are available, unavailable when you're looking at filling up and finding gasoline. So this is something that will come to pass. Another line item before we get into the refining side. So Libya and the NOC is calling out, saying that they're going to put, essentially, at the Arabian Gulf Oil Company announced the cessation of all operations unless it is provided with the funds necessary for production. So this is something that we've seen with the NOC. There's pushback as to when is there going to be oil money available? What is going to be needed? Now, remember, the Libya is up to about 1.2 million barrels a day of exports, which is about 1.3 million of production. So that's going to be something to watch, what this standoff looks like, what the negotiations are going to look like going forward, to see if we have any real disruption as we go through and look at what's happening with Libya in general. Now, when we start looking at some of the other issues that are on the table, we have to talk about Pemex. Unfortunately, there was a loss of life when there was an explosion in the Gulf of Mexico. It impacted 421,000 barrels a day of production. So you have 421,000 barrels coming off. You have about 1.7, 1.8, well, closer to 1.8 coming off from the hurricane. So Pemex they've lost gas lift, so they're trying to replace that right now with nitrogen, which is something that they've used in previous times. So the goal is to bring 421,000 barrels back that they lost per day by Monday, which is hard to see just given the issues that they're facing and what has happened so far, especially based on the damage that was caused at the platform. But that's going to be something to look at. So right now we have, Ida coming through, which is cutting 1.8 million barrels a day. We have Libya, a potential upheaval that could impact either all of or a piece of that 1.2 million barrels a day of exports. And then we have the loss of Pemex's production of 421,000 barrels a day. So now when we look at some of the impacts, because remember, as we were saying, what is going to be the impact going forward? So Fernando Valle put this together out of Bloomberg, looking at the 2.3 million barrels a day of refining capacity, or 12% of the U.S. When you think about it, there's about 8.7 million in PADD 3. So you get an idea that there's a decent amount that is in its path. Some of these facilities have already talked about cutting capacity or reducing. Some of them are saying it's going to be a level 2. We should be okay. So we're going to try to maintain as much capacity as possible. This is when, for anyone who's traded oil and products or energy in general can attest, you buy the news of the hurricane, you buy oil on the news of the hurricane, and then you sell it once it actually hits land, and then you go long products. Why? Because typically you have crude coming back faster, so you'll see a build in crude oil in the EIA reports and a bigger draw from refined products, because you're going to lose refining throughput, which means that they're going to have to pull down from storage. You also have guys front loading and people trying to get products in general. So this will also put a little bit additional support when we look at gasoline supply demand numbers on the EIA show, depending on when some of this is calculated. Now, one of the last things that before we get into some of the data sets, we just wanted to give an update on Afghanistan following what we've been talking about. So unfortunately, there was a very large terrorist attack from ISIS-K that resulted in the loss of 13 U.S. military personnel, as well as 170 Afghanis, which is expected to continue to rise as there's about 200 that were wounded. The additional wounded military personnel have now arrived in Germany, so they are getting the medical treatment that they need and deserve for what they tried to do. And this is something that we always like to say is like based on the wires that were coming in for the U.S. and the U.K., we knew that there was going to be a potential attack, and these individuals still, they held the line, they did what they had to do, trying to get the innocent and those trying to flee through processing and into the airport, putting, again, their lives on the line and doing what was called upon them to do, and giving what, we can all agree is the ultimate sacrifice. So when we look at thousands of evacuees leaving Afghanistan, this gives you a breakdown of where the Afghans have gone: 58,700 in the U.S., with the next largest 8,600 in the UK. So we continue to see the evacuation. There's potential of this wrapping up as of tonight. There's talk about a potential handover to the Taliban for control of the remainder of the airport. There was also a secret operation called Pineapple Express, where it was an all-volunteer group of American veterans that were trying to get people that they were connected to, whether it was special ops, translators, everyone that they could possibly, to get not only their connections, but their families out. And they were successful getting close to 600 people in the cover of night through the Taliban lines and checkpoints to get them to the safety of the airport and evacuated. So thank you again for your service and for carrying this out. So now as we turn forward, some of the questions were, what is ISIS-K? So ISIS-K is obviously a derivative of ISIS. The Taliban and ISIS are not overly friendly. They typically, they both Sunni. They both follow a more a very extreme sect of Sunnism, but it's slightly different. Now, ISIS-K is a bit closer to the Taliban than ISIS, but they've been fighting and they've been in battles over that time period. As the Taliban came through, they did empty the jails, which did have ISIS-K as well as Al-Qaeda operatives. So there's a certain amount of friction, but there's also a certain amount of, well, we have a similar target of getting the West out, of causing impact. So whether or not this was in a coordinated attack or the Taliban tried to stop it, it was a suicide vest. They are difficult to identify. But again, these are some things to consider. And as we go forward and things get a bit more established, we'll start talking about what the Taliban, ISIS-K, the Northern Alliance, and then Al-Qaeda, and what that looks like and what those shifts can be over this time period. So now when we shift to some of the things that, we're talking about Twitter yesterday, and we start looking at what is work from home, what is flexible schedule, what are some of these shifts that are coming, and here's where we shake out. So right now, as things come back, about only 25% of people want to go back to the office full time. But when you look at it, there's fewer that want to be work from home permanently. A lot of it is this flexible schedule. And this is where we continue to see the shakeout of this decentralized office and this work from home or flexible schedule, which we believe is going to become a bit more prevalent and offset some of this suburbanization or rural move from the urban to suburban, because you do need more cars. You will drive more not being in an urban setting, but then how much of that is going to be lost because you just won't be driving to the office as much, or just working from home, or you're in a place now that is a bit more spread out. You don't have to drive as much. You can utilize online shopping, as people have been using Instacart and these other types of opportunities. So this is going to be interesting because this is looking globally. So you can see it's not just the U.S. that wants to have a bit more of a flexible schedule, with 34% saying they'd like to return, with the remainder saying that they would like either all days out or at least some sort of flexibility. So you can see that it's fairly common across the board. Now, when we look at just recent data sets that came out for the U.S., you get an idea. So the trade balance is still sitting there at near all-time lows in terms of what we're taking in, what we're exporting. When we look at inventories continue to be low. Personal income did have a nice bump, was expected at 0.3%, came in at 1.1%. Personal spending was expected at 0.4%, came in at 0.3%. And then when you look at the deflator, or when you start looking at some of these inflationary numbers, what is indicative of inflation, you look at the PCE deflator, which was expected at 0.4, came in at 0.4. Year over year was expected at 4.1, came in at 4.2. Core deflator was expected at 0.3, came in line, and then same with the year over year of 3.6. So you're still seeing this steady grind higher, but as we've been talking about, you're not going to get this continuous move up. We will get another shift because for those that don't know, the Supreme Court officially threw out the moratorium on foreclosures and on the delinquencies. When you start looking at can people get evicted from their homes, that has now been thrown out, so that process will begin and that will start to accelerate. So that's going to be something to watch because again, rents are surging up. So even though we've had a bit of a pause in this inflationary move, we believe rent is going to be that next surge or the next push up. Then when you look at University of Michigan sentiment, it came in fairly in line, expected 70.8, came in at 70.3. Current conditions slightly better as Delta's has started to roll over a bit. But when you look at expectations going forward, they still remain depressed. They were expected at 65.4, came in at 65.1. So putting some of this into context, when you look at the change in personal consumption, you saw some goods came down a little bit, but services have come up to meet it. Overall on a total, we've been fairly stable when you're looking at changes in expenditures. And just to be clear, we do have back to school. We do have a certain amount that is normally seasonally expected, but that's when you start looking at what are some of the shifts. And this next week, we're going to look at what are some of the movements on the goods side, the services side, how much of it is value versus volume, because when you adjust it for inflation, it was actually slightly negative. So those are things that we're going to want to look at because how much of the volume is going to continue versus how much of it is being driven just based on the fact that prices continue to go up, as we talked about in this in the past econ show, looking at PMIs and the internals in terms of prices received and prices paid. So then when we look at U.S. core inflation and streamline it across the 24-month average, the 3-month annualized, and the 12-month, get an idea that we're still in this upward trend. Some things are starting to pause a bit, but we expect to see a steady increase over the coming few months. So with headline PC and core PC rose 0.4% and 0.3% respectively. So it's the smallest increase in 6 months, which was, as you saw with estimates, expected. But there's that next surge up, which again is going to be on that rent side. And then peak headline inflation is the highest since 1991. And near peak core inflation at 3.6% is the highest since the early 1991. So again, you're still seeing this elevated level. And it's just, as we keep talking about, it's going to be that pressure higher. Now, when we start looking at adjusted for inflation, so on the price impact, so the nominal personal spending month over month, you can see was positive. But when you look at the real personal spending, this is, again, factoring in those price increases and what we continue to see coming through the system, you can see that it was actually negative. And that's going to be some of those pressure points that we're talking about when we're looking at what does that spending look like and then what is happening with income and savings. So then when we look at some momentum, 8-month low when you're talking about the composite PMI. And then when you start looking at purchasing manager surveys, this is where we continue to see services PMI at 55.2, manufacturing at 61.2. So you're seeing kind of that steady slowdown, and that's something that is going to continue to get some pressure, still be expansionary again, but just seeing some of that cool off after seeing some of that elevated moves. Now we have the final end to the states, the emergency unemployment benefits. So this is going to expire as of September 6th. So you can see that we're all the states that opted to stay in it or decided to not leave early. It officially ends as of September 6th. So this is going to be something to watch when we look at income, which we'll talk about in a minute. So then when we look at contributions to some of this PC inflation, you can see that it still remains a large amount that is the other side. So vehicles has come down a bit. Pandemic in terms of airfare, hotels, events, that is also still elevated, but you're seeing some of the other pieces outside of, because everyone likes to blame cars and used cars and new cars, and then some of the reopening, but you're still seeing that bid or those elevated levels when you start looking at other pieces that make up inflation, especially when you start talking about food and underlying prices in not only just the food store but in other stores, and then when we talk about rent. So we did get a small increase in the personal savings rate, up to 9.6% versus 8.8%. So that was a nice little turn when you're looking at some of that percentage of personal income. But the one thing that we want to talk about quickly is when we look at the child tax credits. Remember that we talked in this past econ show that came out yesterday. We talked about the child tax credit, how that has started to come through, and that is providing a bit of an uplift after seeing the month of June, that with that fairly big drop as some of these different pieces fell away and started to expire, has now been replaced to some degree by the child tax credit. So then when we put this all together, we have to understand that the unemployment benefits are going to drop away. So you're going to lose that yellow part as we go into September, because it expires September 6th. Some of that will be replaced by the child tax credit, but you're going to see a lot of this compress. So we're going to come back to relying more on that other income and compensation, which is just that normal wage growth. So then when we look at the aggregate compensation, and we did a whole show on wages to show the differences in general, compensation growth continued to accelerate. Aggregate compensation, reflecting both numbers of employees and wages benefits paid, grew at 0.9% month on month, which is, again, that strong pace. There were only 9 months from January 2008 to January 2020 where compensation grew at a faster pace. And as we talked about in the econ show on Thursday, it's that bifurcation, it's really that lower level income that continues to see those increases as everything, when we break it out down into the quintiles, the lower level is still seeing the growth and is providing a lot of that percentage increase, while the other side, in terms of high, middle, low, high, middle, and then middle, low, and then upper low income, you're seeing this either flat or contraction. So you're either getting zero or a slight negative. So the percentages are showing to coming up. And then we're going to break this down into its different pieces next week when we start looking at some of the different econ show and build off of what we started talking about and the show that we did on the econ show on Thursday. So that's all we have for you today. We hope you have a great weekend. It's getting near the end as we approach Labor Day, which will be next weekend. So we'll have a nice long weekend, and then we'll all settle in for a hopefully a nice fall. Something that is a bit more normal versus what we've seen in the past with the impacts of COVID. So again, we hope you have a great weekend, and thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primer Vision Network.